This is the Open on BNN Bloomberg. I'm John Oakham. We're about 15 minutes away from the start of the Thursday session. I know I was saying earlier for September it can be a pretty mixed month, both in Canada and the U.S. But as we move into the fall, it's nice to look back at where we are this year. Now, the first part of the year was certainly dominated by outperformance for the S&P versus the TSX, all those heavyweights in the technology sector. Since the midpoint of the year, the performance has actually been a lot more competitive. Now, Canada has this outsized influence in sectors like energy, materials, financials. Energy's done very well by comparison because of that recent surge in oil prices. But financials have had lesser performance, and certainly with gold names, you got to consider the appetite for something like the U.S. dollar. And our next guest suggests that when you're looking for outsized returns, looking outside of Canada might be a consideration. Phillip Colmar is managing partner and global strategist at MRB Partners, and he joins us. Phillip, nice to see you. Thanks for your time.
Hey, thank you for having me.
Let's just start with the fact that here in Canada, we just had a guest, Francis Donald, who suggested that we're probably already in a recession in this country. I wonder what you think about when it comes to investing in some of those bread and butter Canadian sectors right now.
Yeah, well, I mean, the recession's somewhat debatable, obviously, because we have had some weakness already associated with, some wildfires and one-off effects. But it's clear the economic data is quite soft right now, and that's a vulnerable situation for Canada. I've mentioned that Canada is sitting on a significant housing bubble and a tremendous amount of household debt excesses. So what you really don't want to see is weakness in the economy that does anything to lift unemployment. You've already had an interest rate pinch. So that's part of the adverse Canadian story. When it comes into the stock market, thematically right now, globally, we're in a situation where most of the world, unlike Canada, has pulled away, or investor base has pulled away from the global recession call led by the United States. So they made a misplaced bet earlier this year that we're heading into recessions. We've unwound some of that. Unfortunately, the consequence of that is higher bond yields as we start to reprice in whether the Fed can really cut in this environment, which we don't think it can. So when you think about that on a global scale or from an investment perspective, what you want to do is you want to be in places that are protected from higher bond yields. So we can talk about the global names, but when you look back to Canada, that's a problematic when you're dealing with housing excesses and credit excesses. Higher bond yields is pushing up bond yields here as well, and or within Canada. And so you start to worry about the pinch point for the debt imbalances, those kind of things. So when you come back into the sectors, for example, financials feels the front end of that. So while we actually like financials globally, we would fish outside of Canada. We'd be looking for the mega caps, U.S. stocks, for example, or European financials instead of the Canadian banks. What concerns us is just these mortgage resets, or it's just a wall of resets that the Canadian homeowners are going through. And we're seeing a deterioration in the quality of mortgage lending for the banks that they're going to have to absorb. At minimum, they're not going to get the same credit growth going forward, but we're seeing a huge portion of the market turn into negative amortization debt now. We're seeing a good chunk of the mortgage portfolio get pushed out 25 plus years now. Been a significant increase since interest rates have gone up, something like 20% of their loan book. So it's dramatic. It's something they're going to have to digest at best. And at worst case scenario, if we have a housing downturn, the banks are going to take it pretty much on the chin.
We did talk to some guests yesterday who said one consistent thing about Canadians, even in a higher mortgage rate environment, is they're pretty committed to making sure they meet those mortgage payments. We'll see how it all plays out on the housing front. But I guess going back to the bank case that you're making, looking abroad versus Canada, is it an earnings deterioration? Is it a profit deterioration for Canadian banks that you're most concerned about?
Yeah, the Canadian banks have done well in terms of in recent years of being able to perform and do reasonable earnings. And we think that there's a case in the near term that there could be some bounce in terms of the global economy picking up and stuff like that. And so the near term earnings would be okay. But I think it's really a digestion, and particularly on a relative basis when you're a global investor. Canadian earnings are going to have difficulty. They won't be able to get the same credit growth. The U.S. Canadian household sector is stuffed with that at this point. So getting the same kind of credit and loan expansion is going to be quite difficult. They're going to have to digest some of these losses. And as you said, Canadians are committed to pay. But right now we're seeing an increasing number of Canadians that just can't pay the interest resets, let alone the principal. So there's an issue. It's not necessarily devastating at this point, but it does mean lower relative earnings versus the rest of the globe. There's some cheap financials abroad that you don't have to take that kind of risk. And of course, in the tail risk scenario where we did have a housing downturn, I deal with or influence and consult many global investors. Global investors will pare back on Canadian stocks in that turn, and some of the hedge funds will probably take a run at the short side of the Canadian banks just because of the liquidity side of it, whether rightfully or wrongfully. So.
The other component to the Canadian market that I alluded to that has done well in the second half is oil. And, it's connecting all these dots is complicated. Some people look at the inflation story, they see it as inflationary, they worry about what that means for the economy. And subsequently, I guess that might make you worried about financials. But for investors in energy stocks, they've been waiting for more indications of a tight supply market. We're seeing that right now. How do you have to balance that? If you're looking abroad for financials, what about exposure to commodities right now? How do you feel about that?
Yeah, we're more constructive on that front of it. Canada, stepping back, has the two sectors that we tend to like on a global basis. We do like large cap financials, and we do like energy. The problem is with the financial exposure that we've highlighted. Energy, we like industrials and other types of cyclicals, some of the rotation away from the tech plays with the higher bond yields. And so energy, as the world economy is firming, I think there's still some upside surprises there as we unwind some of those recession bets. Oil's really gotten a bid towards it. And so energy tends to be a better place to put your money. Now, that being said, our preference within the energy space is oil services versus the producers. And so that does, again, lend yourself to some other names, maybe in the US market, things like that, as a preferential bet. But that being said, if oil prices continue to move higher, we are going to see the producers continue to do well. So energy is one of the areas where, if you looked at the two big sectors of the Canadian economy and you picked one right now, it would probably more certainly towards the energy side. As long as bond yields continue to rise, we'd be worried about the banking side. So we'd focus there.
All right.